Hello and welcome to this quarterly update with SKAGEN Global and Portfolio Manager Søren Milo Christensen. First, Søren, SKAGEN Global is ahead of its index in the third quarter. Give us a quick recap of what happened the last 3 months.
Sure. So when you look at returns over the past 3 months, it's important to remember the backdrop, right? So we entered the quarter on the heels of the Brexit vote, which obviously created a massive sell-off across global equity markets. So we ended the quarter from fairly depressed levels. So what we did was, in the panic sell-off post-Brexit, we added aggressively to some of the holdings we felt were weak for the wrong reasons. So specifically, some of our US financial holdings and some of our UK listed holdings with significant exposure outside of the UK. And to answer your question, I think that's the main reason for why we did better than the market last quarter. We were well rewarded for being contrarian, for going against the market, because as risk premium normalized, those stocks reverted to their levels prior to Brexit. And you see that very clearly if you look at the top contributors last quarter. It was AIG, so global insurance company, Citibank, global bank, and then G4S, a global security company, but listed in the UK.
You mentioned financial, and SKAGEN Global has a significant exposure to financials. Now, they have performed quite well in emerging markets, but not as well in developed markets. Why is that?
So I say the overriding reason for why the developed market financials have done poorly this year is because interest rates expectations have come off. And clearly, lower interest rates is negative for certain type of financial holdings like banks and life insurance companies. And you're absolutely right. I mean, we do have a significant exposure to financials, mainly US financials. And the investment thesis is pretty clear, right? If you look at these companies, even if rates stay where they are today, and remember, in developed markets, many places that rate is 0. In some jurisdictions, it's below 0. But even if we stay at these levels, we've still been able to find companies that can generate significant free cash flow. And they can do that because they have lowered their cost base and because they're not growing their balance sheet.
US elections are coming up swiftly. In just a few weeks, we'll know who will win the elections. Have you done anything specifically to position the portfolio?
Yeah, so I think when you talk about the US election, there's no doubt that from a financial market perspective, with Hillary, you sort of know what you're going to get. Whereas with Trump, I mean, he's seen as more of a wild card. And so no doubt, if we have a Trump victory, that will create uncertainty. The market doesn't like uncertainty, so that will create volatility, and most likely on the downside. In terms of how we position ourselves, I would say we don't try to position ourselves to gain from an event where we don't have an edge in analyzing the outcome. But what we do try is to make sure that we've constructed a portfolio where we are not overly exposed to a certain event happening. But then, of course, I mean, if we have a Trump victory, we know that the market has a tendency to overreact. And then, of course, we'll be ready to take advantages of any mispricing, just as we saw after the Brexit vote.
Thank you very much, Søren, and thank you very much for watching.